Hi, my name is Chris Cadigan, and today I'm going to be talking about ratio analysis. Ratio analysis is quantitative analysis of the information in a firm's financial statements. This analysis evaluates a firm's liquidity, leverage, activity, and profitability. We chose to compare our ratios to American Eagle because they own Victoria's Secret's largest competitor in the women's underwear market, Aerie.
Today we are comparing Victoria's Secret and Aerie, a fashion brand owned by American Eagle. We're comparing these two companies because they both compete in the women's fashion market segment. We will be comparing liquidity ratios, leverage ratios, activity ratios, and profitability ratios for these two brands. So we're going to get right into the liquidity ratios. Victoria's Secret's current ratio is currently 1.62 and Aerie's current ratio is currently 2.0. What this shows is that Aerie has twice as many current assets as current liabilities, and Victoria's Secret has about 1.5 times more current assets than current liabilities. Victoria's Secret has a quick ratio of 1.02 and Aerie has a quick ratio of 1.18. This is basically the same as the current ratio, except the quick ratio doesn't take into account inventory because it measures how quickly a company can pay off debt, and it's impossible to use inventory to pay off debts. Victoria's Secret's net working capital ratio is 0.099 and Aerie's is 0.505. This shows that Victoria's Secret is not liquid because it has a large investment in fixed assets. Next, we're going to get to the leverage ratios. Victoria's Secret's debt to asset ratio is 1.09 and Aerie's debt to asset ratio is 0.318. Generally, companies want more assets than debt, so this number should be as low as possible. However, this shows that Victoria's Secret has more debt than assets, while Aerie has more assets than debt. Victoria's Secret's debt to equity ratio is 0.084 and Aerie's debt to equity ratio is 0.468. This shows that Victoria's Secret does not have a lot of debts and most of their operations are financed through sale of stock and other financing activities. Next, we're going to get to the activity ratios. Victoria's Secret's inventory turnover ratio is 6.19 and Aerie's is 5.57. So what this means is that Victoria's Secret sold and replaced their inventory about 6 times in the last calendar year, while Aerie did about 5.5 times. Victoria's Secret's accounts receivable turnover ratio is 40.75 and Aerie's is 51.55. So what this means is that Victoria's Secret collected their accounts receivable balance about 41 times in the last calendar year, while Aerie did about 52 times. Victoria's Secret total asset turnover ratio is 1.55, while American Eagle's is 2.24. This shows the value of a company's sales or revenues generated relative to the value of their assets. So generally, the higher this number, the better, because it shows that the company is better at leveraging their assets to generate revenues. And Victoria's Secret's fixed asset turnover ratio is 2.60, while Aerie's is 1.32. So this measures operating performance, and the higher this number, the more efficient the company's operations are. This is also due to the fact that when we looked at the net working capital, we found that Victoria's Secret had a high investment in fixed assets, so it makes sense that they're using these fixed assets efficiently and they're generating better returns for the company. Next, we're going to get into the profitability ratios. Victoria's Secret's gross profit margin is 39% and Aerie's is 37%. And what gross profit is the profit that's left over after costs of goods sold are subtracted from sales. And Victoria's Secret's operating profit margin is 14% and American Eagle's is 8%. So what operating profit is it's the profit after cost of goods sold and all the other operating expenses are subtracted from the revenues. And net profit margin, which is when all expenses are subtracted from revenues, Victoria's Secret's is 8% and Aerie's is 6%. So what these margins show is that Victoria's Secret is more profitable than American Eagle, and they've found a way to increase their sales price while limiting costs to stay more profitable, while Aerie has not done so.